You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Hello, welcome to the show. It's called Talking Real Money. I'm Don. That's Tom. We love helping people deal with money better than they've dealt with it before, because I have to tell you something. No offense. Really like all of you, but most of you deal with money really badly. You do. 855-935-TALK is our phone number, 855-935-8255. I'm Don McDonald. Over there's Tom Cock. And you are the people we want to help. So call us, 855-935-8255. You know, I think we should just start with the phones.
Sure, let's do that. We usually have some witty comment to begin the show, but since we have so few of those anyway, let's just go to the callers.
Doug, you're up. Welcome to Talking Real Money.
Doug was there, and then he was gone.
Oh, there was so much.
So we'll have to go back to the.
No, I've got another question. Somebody sent me one to don@vestory.com. So
no one's chatted though. Come on, somebody go chat. Just
it's there if they
go
need
to the website.
Don't make them.
I know, but it's easy.
All right, we've got a question.
Anyway.
Don and Tom. It says Don and Tom.
Please.
I get top billing. Could you advise?
It's better. By the way, that's better than the guy last week who said Don and Don.
Yeah, I like that a lot.
It's Tom with a T-O-M and Don. Anyway, go ahead.
Could you advise a good place for cash in an emergency fund with no immediate need for it? Are there any advantages to an online bank account, etc.? P.S. I have seen the PowerPoint slide of Tom's mattress with all the currency under it. That's in our presentation now.
That's right. That's right. I love it. Yeah. It's one heck of a mattress.
It was really nice.
You got to get by the 100-pound black lab who'll probably lick your hand.
Killer black lab.
Yeah, really, he'll bark.
Do you want to start with your opinion, which is probably going to be totally different from my opinion? What?
So, okay, but remember, part of the question was, can you find something online? You could go to bankrate.com.
Thank you. That's where I was going to start.
Okay, and you could find the highest earning savings account, which is going to be...
Which is VO Bank at 1.5%.
VO Bank at 1... Okay. Or, and
1.
we've talked about this, and Don doesn't like it.
Yeah, what's the fund? What's the symbol?
VFSTX.
VFSTX.
It's the Vanguard Short-Term Corporate Bond Fund. Now remember, there's a modicum of risk to this. Mm-hmm. This is money. These are bonds issued by corporations like Microsoft. Mm-hmm. Probably pay you back.
Probably, but
they do it mostly for tax reasons anyway.
Does its price fluctuate?
There's a risk.
Does its price fluctuate?
It does. And so that would be different than putting it in a savings account where you wake up every morning and the same amount is there.
Right.
Or if you needed the money the next day, and the money would be there. It would not be there in this case.
The difference in yield between VO Bank and VFSTX is?
Probably 0.5%.
0.2.
Wow. It's really come down a long way. It was over 2, I think, to start the year.
So therefore, you get 1.7.
Yeah.
Or 1.5 at an FDIC insured bank with no volatility.
Oh, you're getting 1.5. I thought you said 1.05.
1.5%.
Wow, I'd probably just go with the bank then.
I would too. Because it's FDIC insured. That's the key.
Now remember, there are other times when the difference between that savings account and the yield on the VFSTX have been larger.
Has been greater.
This is not one of them. But this is not one of them. So
this is a period. We are in a period, and this is something we need to get used to for a while. We don't know how long this will last. We are in a period where rates across the board, from the long end of the spectrum to the shortest end of the spectrum, are almost identical. We have a yield curve that is essentially what they call flat.
And I will say one other thing about that. If you have not looked into, for example, refinancing your mortgage, you really should. I mean, I'm getting a 15-year at 3.2 or something?
Oh,
I forget. No, less than that. I had all the numbers except that number.
I just looked up a 15-year. I got a quote on a 15-year yesterday.
I think it's 2.8.
2.87.
Yeah. I think that's what I'm looking at. So, I mean, you can get some very inexpensive money, and that saves a lot in interest.
Yeah, it can save you a lot of interest because that is and it's almost nothing. And when people call and go, should I pay off my mortgage early? No, you should not pay off your mortgage early if you've got a mortgage at 2.5% or 3.5% or even 4.5%. Actually, now if you're at 4.5%, it's starting to make sense to refinance even those, which is just shocking. 855-935-TALK is our phone number, 855-935-8255. Give us a call. We're talking about your life, we're talking about your money, and we're talking about things that are truly critical to enjoying a great future.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
For your real life and real future, Tom and Don are talking real money.
And Doug, Bryce, Sue, Sally, Sam, Stephanie, give us a call at 855-935-TALK. I just said the first two because they had called earlier and then hung up. 855-935-8255. And you can also, as somebody did earlier, Jeff, send a note to Don at vestory.com because I'm looking right at my email right now, so it pops right up.
And Fred sent you a note, too, and wants to put a dog on the website or something.
Fred wants to put a dog on the website. Fred,
apparently thinks that's more attractive than the two of us or something. I couldn't get it.
My wife has done the same darn thing. She said I should put a dog on the website. So
dogs and children, everybody loves them, right?
They do too. All right. I wanted to talk with you about a little source of confusion, I think. A lot of you in this financial mess we've had in this country, a lot of unemployment, a lot of people out of jobs. And then the CARES Act allows you to take money out of your retirement plans for a period of time to cover some of your needs. And it allows you to take them out without penalty, but you still have to pay the taxes. But is it a good idea? I mean, I got a call from a gentleman on the podcast who wanted to know if it was a good idea to pay off his mortgage. At 3%, where you should be, by the way, should be in the 3 range, that would be silly.
There's no reason you'd be paying the tax. You have to pay the tax within 3 years. They're giving it. This is part of the confusion is people hear, I can just take it out of the retirement plan now and you're gone.
You're going to have to call me back. You're going to have to disconnect and get another line because you sound like a robot, unless you've become a robot while I wasn't looking. Maybe Elon Musk came into Tom's house and hooked him up to the brain machine that sucked his brain into a computer program because you're just... And I don't want to blame Comcast. Although I'm tempted. I mean, when mine works so much better and I have a little phone company called Smart City, that says a lot, but yours is really cutting up. So give me a call, 855-935-TALK, 855-935-8255. And please, please don't mess with your 401k or your IRAs because you're doing a couple of things. One, you're going to pay taxes. You're going to pay taxes on it. And even if your income is temporarily reduced, you're going to be back to work one of these days. And unless it's an absolute emergency, and by an absolute emergency, there are only a couple of things that qualify. Getting a new car, that does not qualify. Taking a vacation does not qualify. Putting a new roof on the house, patch it for a little while. The things that qualify are you going to get thrown out of your home tomorrow? If you're going to get thrown out of your home tomorrow, then take some money out. If you're starving, yes, please take some money out. Otherwise, your retirement funds should be sacred, sacrosanct. You shouldn't mess with them at all.
Yeah, and here's another thing that I find interesting.
Oh, less robotic.
During all of this, right? I mean, all people taking money out of their 401k, market going down, etc. What now can you go invest it in your 401k because the government has decided it's okay? Private equity.
Oh,
really?
I forgot about that. Thank you for reminding me.
Yeah,
Now explain what private equity is.
Well, yeah, okay. Private equity is all the stuff that, sad to say, most of us, you and I, the little people that drive Hondas.
No. See, I was going to say it differently. I was going to say, I'm happy to say it's the kind of stuff you and I can't get into because it's the kind of stuff, generally speaking, you don't want to get into because the risks are high.
We're not special enough.
If you're a billionaire, you can afford high risks.
Yeah, you can take what they used to call, I don't hear it so much anymore, a flyer on something and hope it works out. Hope it turns into the next Alibaba or Luckin Coffee. But that last part was a joke. But seriously, private equity, really? I mean, this is exposing your money to very hit and miss propositions, companies that may or may not work, ideas that they're going to give them a try. I think this is a big grab by private equity firms to get their hands on your money because they can't get it today. So, but I don't like it. I don't think it makes sense. But by the way, you're not going to be able to directly, according to this piece, get private equity in your 401k. They're going to add it to target date funds.
Oh,
so it's going to be one of the assets that they include there. I don't think you need this. Again, this is the kind of thing you invest in. I think you put it right. If you have a whole lot of money and you want to take a chance on a new type of, maybe made a bet on the company coming up with the coronavirus vaccine. Well, this Saturday.
Do you know that the private equity industry has a lobbying arm and a trade group? It's called the Investment Council, and their slogan is private equity supporting America's recovery.
Well, they can go ahead and do that. By the way, private equity has been in a thing called pensions for a long time, and how have they done with their returns?
Not as well as just buying the market and holding it.
Just buying an index. So this is a bad idea. It was a bad idea when they came up with it. I think it continues to be a bad idea. So
855-935-TALK. Do we have time? Yeah, we have time. Go.
All right, let's go to the phones. Alan joins us here on Talking Real Money. Hi, Alan.
Hi, good afternoon. I've been listening to you guys for decades, or Don for decades. My simple question is,
He's making me sound old.
What is the rule on selling a house and downsizing and the capital gains you have to pay if you downsize?
$500,000 free every 2 years. Every 2 years.
Yeah.
Every 2 years, you can take up to $500,000 in capital gains and just not pay taxes.
Okay, what if you got a capital gain over $500,000?
Then anything over the $500,000, you have to pay taxes on. But that's not bad.
And let's just explain that for people. So let's just say you bought a house for $300,000 and today it's worth $750,000. The government's going to would have wanted you on any other type of gain to pay capital gains tax on the difference between the 3 and the 750. In this, in this case, you do not.
And the other thing that you need to think of, you can add things to that cost basis. Remember, if you've put some improvements into the house in a certain period of time, and I don't know what the exact rules are, you'll have to look those up or talk to your accountant, but you can sit down and calculate that new cost basis. How big a difference is between what you paid for the house and what you're going to get for the house?
About $900,000.
You are going to have a hefty capital gains, but at least you can get rid of $500,000 of it, because if you had to pay gains on the whole $900,000, yeah, and
especially in that place. Well, no, because there you'd be throwing on the Obamacare surcharge.
Right,
it'd be very expensive.
Right, there's the surcharge, and wow,
on top of the rate.
So at least you get a break.
You subtract the 500, and you end up with 400.
Yep,
now,
correct.
Yes,
that's right.
Your income for the year then. So you're in a really
it does not go as income. It is separate. It is long-term capital gains. So it doesn't actually creep your tax bracket up, but there are creep up points in the capital gains rate, plus that excise tax, that Obama medical tax on top of that. Thanks for the call. I'm Don McDonald.
Are talking real money.
Did you know I wrote a book? Yeah, about 10 years ago, I wrote a book about investing. Financial Physics, with an F, How Money and Investing Really Work. It's a short read. It's a really easy read because, well, as you know, investing is way too easy to be this complicated. And it's been on sale for a long time at Amazon. I updated it in 2018 to a new version. But if you don't want to buy it, you can go buy it at Amazon. It's $10. But if you don't want to buy it, if you want it free, well, you can get it free two ways. One, you can get a PDF copy by going to talkingrealmoney.com/free. talkingrealmoney.com/free. If you don't put in the /free, you can't find it. The other way is if you have an iDevice, like an iPhone or an iPad or a Mac, you can go get an interactive version of the book, a special edition that I made that's actually interactive, that's got videos and motion and things going on. And that's also free. Just look for Financial Physics, FYSICS, in the Apple Bookstore or Apple Books or whatever they call it now. Or go to talkingrealmoney.com/free, talkingrealmoney.com/free. And I guarantee you'll enjoy the PDF or the iBook or your money back. Check it out, talkingrealmoney.com/free.
Your guides to a really great financial future. Tom and Don are talking real money.
Yeah, I just did a really, really rough figure on the capital gains tax on that $900,000. And since you can get rid of, you're really in luck. If you had to pay tax on the whole thing, it would have been almost $200,000.
Because it's the 15 plus the whatever the surcharge.
Yeah, but in your case, it's going to be more like $77,000 or so.
By the way, people oftentimes complain about that. You also got to remember you made a lot of money on the transaction.
Yeah, it's money. You're ahead of the game.
Right. It kind of worked out. So
if it was a choice between not getting the extra money,
right,
and not paying the tax versus getting the extra money and paying the tax, I'd pay the tax. Take the extra money. 855-935-TALK. That's our phone number, 855-935-8255. Give us a call. It's easy.
You know, and one of the things that's lacking when it comes to money, most of the time, but we see
in my wallet, it's just the money.
Yeah, exactly. The amount is good advice. There's so many people. And by the way, I'm going to look forward to going back to see what people are saying in March. The experts, the pros telling you, here's what you've got to do now. We're headed. Remember, there was somebody saying the market's going to go down by 75, 80%, you know, blah, blah, blah.
Oh,
blah.
I think that was Harry Dent.
It probably was.
Anybody who pays any attention to Harry Dent apparently fell off a horse and got a dent in their head.
And we know, because we see your portfolios often, that most of you don't have the proper mix of stocks and bonds. Most of you are really either too risky or not enough risk. And most of you are paying way too much to others to have your money taken care of. And most of you don't know how much that is. And you don't know that somebody who's taking care of your money is not acting in your best interest. I think that's always the one that's the eye-opener, Don. People think, no, it's my stockbroker. He has to do what's best for me. Right.
That is one of the big lies out there. By the way, I want to just add something there. There are several investment advisors, and by the way, we know many of them in the Seattle area who right on their website, that we are a fiduciary, and then I dig into their Form ADV Part 2, and I find out that they sell stocks, they get commissions on those, they sell insurance products, they get commissions on those. Anybody, and this is what's so hard, you got to read their ADV, it's a pain in the neck, but if you look, you'll find out that they're a fiduciary sometimes.
Yeah, they're what's called duly registered. Yep. The registered investment advisor part of the time, and then they put the other hat on, and they're a broker dealer.
And they're a commissioned salesperson, which is a conflict.
It is. And we find a lot of bad things happen to people in that circumstance. We want you to protect yourself. It's your money. This is the other part I find fascinating, all this. Oftentimes when you try to take money from broker dealers, they throw up a storm. They have a hizzy fit like, we can't do this to me. Well,
I thought we were friends. I thought we were friends. As a matter of fact, let me just give you, let's say for a second, you got a fiduciary advisor who charges you 1% per year. Okay?
Yep.
You got a duly registered advisor, but they do give you a fee-only account. But by the way, I've got a list of them at talkingrealmoney.com.
Yeah, you do. It's great.
TalkingRealMoney.com/compare. You can look at the fees for most of the major firms in the country.
Shocking.
But let's say, like most of those, they charge 2% per year. But the broker you're dealing with is a really good friend. So you have $1 million invested with the advisor at 1% or with the broker advisor at 2%. Is that a friend to whom you would hand a check for $10,000 every year just because they're such a good friend?
Now, normally I would say no, but I don't want a certain attorney to put something up on the screen to show me that I have made that transaction. So I'm going to say maybe.
You talking about your brother?
I just don't want to say no anymore because I don't want to
no.
Well, just a minute. Let me take a look here and put that pop down up, so I don't want to be there. Yeah,
MarketWatch did a study that found that, get this, there were about 1 million financial advisors, by the way, a term that means nothing in America.
Anybody can call themselves that.
Anybody. You can call yourself a financial advisor, and let's say you know nothing about money. You can call yourself one.
You're in good company.
1% are always required to act as a fiduciary. That's why we're having a great big class via Zoom on the 10th at 8 a.m. Pacific time. It's called something about bad brokers and finding really good ones. I can't remember the name. Go to TalkingRealMoney.com and you'll find the name because now you really want to know. TalkingRealMoney.com. Click the event button.
Tom and Don are talking real money.
You've heard that about 99% of all financial advisors are not always required to act in your best interest. You've probably been pitched financial products by all manner of friends and relatives, and the investing you have done is probably a hodgepodge of ill-fitting pieces that are doing little to provide the financial security you need. If you're looking for a 100% pure fiduciary, and we'll put that in writing, low-cost, fee-only advisor who always puts you first, give Vestory a call at 800-386-3004. That's 800-386-3004, or visit us online at Vestory, VESTORY.com.
Reality radio for a really great future. We're talking real money.
Because money's a really big part of your life, and it's very important that you deal with it properly, that you plan for the future. You don't just sort of stumble your way into the future, at least when it comes to money. You can stumble your way in when it comes to other stuff if you want, but when it comes to money, if you stumble along, you could end up like that guy who put all his money in Luckin Coffee, and he's now fresh out of Luckin.
His luck is gone.
Yeah, the luckin' is gone away. Oh, we do get questions, by the way. If you can call us at 855-935-TALK. That's easy. Or you can send them in just to Don at Vestory. Or we make it really easy. You go to TalkingRealMoney.com. You click on the contact form. The contact form. And we got.
Or you can chat. Live chat.
Yeah, you can go.
A lot of takers on that one. A lot of talkers.
This one is about taking retirement income.
Yeah.
Okay, pay attention.
Okay.
This could be difficult for you.
Got it. Yep.
I don't know. This
Probably.
Could be tough. We've spent the past 40 years saving and investing for retirement. And we think we've done a pretty good job. Over the past 40 years, we've learned a great deal about saving for retirement, but not very much about how to carefully spend some of what we've accumulated in a way that will hopefully last for up to 30 years. What can you tell us about retirement income planning, Tom?
Wow, that set me up.
I know. This is your area of expertise.
Yeah, well, and this is
an annuity. An annuity.
Yeah, we'll roll you right into what was the one we talked about last week? I forget the new name. They come up with a new name.
Oh, gosh, I forget all the.
Here's the way I would do it if I was doing this on my own. First of all, I would decide how much money I want to spend every year.
Mm-hmm. Okay.
And do that. I would figure out what I'm spending today. There's a lot of people are going to tell you, oh, you only spend 80 or 90% of your pre-retirement income in retirement.
Spend it
all. I'd run it at 100%. I'd run it at 100%. So I'd say the number is, and by the way, how to find the number, because people are in denial about this. People bring us spreadsheets all the time. Here's how much I'm making. But I make $250 and I'm only spending $40,000 a year. Yeah, right.
Where's the other
you're
$210?
You're a great saver. Yeah, or you're giving the government a lot. I would take gross income minus taxes, minus what I'm saving, everything else you're spending. That's the number, right?
You just sound like the number. Sounds
That's
depressing, though.
Well,
when you think about it. Yeah.
That's what you have to solve for. So then you're going to say, okay, how do I get that? Well, you're probably going to, if you've been working for 40 years, was it 30 years? You're probably eligible for Social Security. Maybe your spouse is, and you want to optimize that the best you can. Maybe a pension, maybe not.
Wait, let's go back to the Social Security, because you need to know how much you're going to get. Go to ssa.gov. If you haven't already, set up an account and find out what your check is going to be. They'll tell you right there.
Yeah. And by the way, everybody should set up an account, because if not, somebody could be defrauding the money that's in the trust for you. But anyway, so start with that. Social Security plus pension. That's a number. Then you got to solve for the rest of it, right? You got to say, okay, between Social Securities and our pension, we're going to bring in 75 grand, but we need 100, just for sake of argument. But we have this pot of 800,000.
Okay. 800,000.
Okay.
Yep. I got my pot here. Not that kind of pot. This is my pot of money. This is where it gets a little more complicated. And by the way, this is, for most people, it really does make sense to get professional advice around this topic, because it's somewhat complex. But let's just say you're solving for that. You need to take out, 4% of 800,000 would be 32,000 a year, right? So there you go.
So you don't even need, you could take out that much, but you'd have to put the money into stock mutual funds and bond mutual funds. You got to get some growth there if you're going to want to have it last you for 30 years. If you take it all and put it in the stable value funded Boeing, I can almost guarantee that you will run out of money under that scenario. Or if you take it all and you put it all in bonds. Well, with bonds yielding 1.5% and you're taking out 4%,
you're down 2.5% per year, and you're having to draw from your principal. It means you're going to run out of money.
Yeah. So you need to figure out, this is, again, part of the work that thank you for saying that, Don, that we do, I think, very well, and we do a lot of, because most people come to us and say, what? Not, do I have enough in small cap value? Am I properly exposed to international stocks? They say,
no, the things we think you should care about, but really, can I retire?
That's what everybody wants to know. And will the money last? Right? So that's the kind of work. And by the way, we're going to talk about this on June 10th, because sadly in this industry, most of the focus is not on that. It's about which stock to buy. I'll get you in a great fund or this, that, but you really got to do this planning work. Great question.
Or I'll sell you an annuity, get a commission, and move on to the next customer. Thank you very much for stopping by, because that's really the way the industry works. It's next commission. You need somebody who manages your money. 855-935-TALK.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
For your real life and real future, Tom and Don are talking real money.
855-935-TALK is our number, 855-935-8255. You know, I think we're going to do this right now, because the more I read about this, the more fascinating it becomes.
I know what you're talking about.
It's so interesting. I just was looking. Do you know, before we even get to this one, do you know that there are 33 surviving spouses of Spanish-American War veterans?
Now, for those of you
surviving spouses,
not as interested in history as Don and I, we happen to know that we both had the number right, by the way. That war happened not in the 20th century. That happened in the 19th century. 1898.
Yeah.
That's a long time. That's like 122 years ago.
Just 7 years ago, the Associated Press ran a story stating, get this, $40 billion a year was being spent in this country to compensate veterans and survivors of the Spanish-American War, World War I and II, Korean War, and the Vietnam War. But of that, there are 33 people from the Spanish-American War. Oh, wait, and 18 of their children are still to this day getting benefits. But this is even better.
Well, and if all that upsets you, that we're still
1898,
they signed up for that. The last person to get a Civil War pension?
Civil War.
That's the one.
Wasn't that 1865 to 1861
to 1865, kind of a long time ago. 90-year-old Irene Triplett, she died this past week. She was the last person to be getting a Civil War pension. Now, okay, we weren't spending a whole lot on this, folks.
$876 a year.
Yeah, it's $73.13 a month. It's not a lot. And her father.
Yeah, if you're sitting around and doing the math and you're going,
How could that happen?
She
Right.
would be like 160, 70 years old.
You thought I was old to have a 12-year-old, but her father married a woman when he was 83. The woman was 34, and they had this child.
And the child
This
had
is
disabilities.
1924. Yeah, right.
So therefore, she was covered for life.
Yep.
By the
With
veterans'
this
pension.
Yeah. $73 a month. So 33 from the Spanish American War. That's fascinating. Really, that's going back a couple of years.
But what the rest of the story, as Paul Harvey would have said back in the old days, the rest of the story is that back in the early 19th century, early 20th century, a lot of young women who really didn't have any other way of surviving on into the future started marrying old Civil War pensioners.
Now, by the way, I think
their pensions.
To get the pension. Here's here's what the lesson I learned from this, because this is happening right today. Should you take the pension annuity, or should you take a lump sum and invest it if you have the option? Now,
in this
look
case,
at this. No, I mean, in this case, $73 a month is not much of a benefit. Yeah. Had you been given the option of whatever money it was, and you had invested it.
Oh, yeah.
That's what I'm saying.
If she had gotten, let's say,
bingo,
$876 a year, so the buyout probably would have been about 10,000. No,
right.
Let's say 5. Let's say 5.
Make it 5,000.
And she married him in what year?
Well, no, she didn't marry him. This is the child.
When did her mom marry him?
Well, the pension. Oh, her mom married him in 1924.
Okay, so let's go. Well, I can go to 28. So let's go to 28, and let's just be crazy. We're gonna say she's 35 years old. We're gonna put the whole $5,000, the whole kit and caboodle into a diversified stock portfolio, and we're gonna hold that until today. We're gonna just hold that until today.
Yep.
And we put the whole 5,000. And we got to go back to 1928, Don. Go back.
Yeah, that's
so far down the screen I can't see it. There it is. All right. She would have made an average annual return of 11% per year, compounded 5,000, $76 million.
Yeah, which would have provided a whole lot more than $73 a month. I mean, but this is part, because this is I think this is very important, because emotionally, a lot of people say, I just want the monthly. I don't want to mess with it. Mm-hmm. I don't want to have to wake up and find out there's this virus that wrecked the market, whatever it is. I'll just take the 7 months. This is a lesson learned. You end up, because inflation will reduce the amount of that pension by about half by 100% in about 24 years, right? Inflation will have doubled the prices of things. So you'll be getting half as much money. That's what I was trying to say.
Yeah, I just
this is in real dollars, right? What it really would have.
Yeah.
So even if she had drawn the, let's go crazy, $100 a month,
you still would have done better.
$1,200, you still would have had a lot more money.
Oh, wait, yeah. And by the way, over that entire period from when she married him, the pension amounted to $82,000.
Yeah, quite a difference. So, and by the way, let's make for clarity, you could not get a lump sum from the government. That was not available,
no,
I doubt.
But
a lot of you right now are looking at that from a rather large employer in the Seattle area, trying to figure it out. I'm trying to say it's a big decision.
And if you're an 84-year-old retiree and some 30-year-old woman is, trying to marry you for your money, it's better for her if you take the lump sum. All right.
Indeed. Oh, God, that's terrible.
I don't even know if I'm going to have time to get to this question now, because we spent so much time. Yeah, I have time. All right. This one, it came in online. Rebalancing with 401k contributions. You ready?
Mm-hmm.
Thank you we gave him thoughts, I guess. Thank you for your thoughts on rebalancing in March. My rebalancing targets were triggered at that time to move some bonds into equity small cap value, and the results were pleasing. That's an understatement.
Have been pleasing.
Yeah, have been pleasing. With the recent market rise, my bonds are now underrepresented.
Oh, I know where we're heading on this one.
I contribute $4,000 monthly from payroll contributions to my 401k. Should I temporarily redirect all contributions to just the total bond plus tips to catch up and ignore equity for now? Or should I continue to spread my regular contributions throughout my equity bond positions?
I would, number one, decide what my stock to bond ratio was.
Well, he's got that. He says 5% off his 60-40 target.
Well, if you're 5%, I probably wouldn't mess with it.
Well, but if he's putting $4,000 in, he could, for a couple of months, just put all those toward the bonds to get the balance right. It wouldn't take long.
Yeah. Okay. Yeah.
You could temporarily do that.
I think it's a nit, but yeah, I guess so.
Because at 5% is when you start thinking about rebalancing, right?
Yep, indeed. But if you start doing this too much, you're going to get whipsawed too. This is not the same thing as selling something and buying something else.
Right.
This is simply new money coming in. Should he change it so the new money goes more predominantly to the things that have
I would.
Well in the last 6 weeks? Sure.
Yeah, I would do that. I would not. I agree with you. I would not do a complete rebalance at 5% because, as you say, you're going to get whipsawed. The trick for most people, just do it once a year. Do it once a year, no matter. That's the easiest way to rebalance.
Yeah.
Now, we do tend to rebalance our clients' portfolios when they get way out of whack. But you don't need to do that on a regular basis or you'll drive yourself crazy. But to change your contribution amounts for a little while, why not?
Most people won't do it because it's very counterintuitive. As we talked about at the beginning of the show, in March, you were selling bonds, the safe stuff, and buying stocks that had gone down 35-40%.
Oh,
most people won't do it.
And most of the stockbrokers at the bottom were saying, oh, yeah, you know what? You do need to get out of those stocks, and we're going to put you into something. Well, let's put you into bonds. Or a nice
annuity.
Yeah, or a nice annuity. You know, when they're selling low and buying high, that's what happens with brokers all the time because they're reacting emotionally.
Or they say, you've been in a fund that went down. You call them up and say, that fund is horrible. Oh, you're right. That's a horrible fund. I got a better one. We'll move it into that. That happens a lot in this industry, sadly.
Buying
but truth.
High and selling low. That is exactly the way you don't want to invest. 855-935-TALK. I want to give you that number because you can call it 24 hours a day, 7 days a week, or you can send your questions in at talkingrealmoney.com. Hit the contact button, and those will come to us, and we'll answer those on a future podcast or a future show.
Tom and Don are talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.